Let us now discuss about stock dividends in a bit more detail. So we have understood earlier that stock dividends are not cash dividends, neither are they some asset kind of dividends. Instead, the company actually issues shares as dividends. So what are the implication of issuing shares as dividends? So let's take a case where originally there were 100 shares and there is a 1:1 stock dividend announced. 1:1 stock dividend would mean for every one share the owner receives one more share. What will happen thereby is that with this the overall shares would be equal to 200. So all shareholders get 1:1 kind of a share. So 100 shares it will improve to or increase to 200 shares. Now think about the overall impact on the balance sheet, asset and the liability side. Has cash changed? No, nothing has changed. Did asset change? No, nothing has changed in terms of asset. Has liability changed of any sort? Even the liability has not even changed. Just look at the shareholders equity section where earlier you had 100 shares, now you are showing the same capital for 200 shares. Okay, so instead of 100 now it is 200 shares. So only the shareholders equity section is affected by this. So one effect is definitely on the shareholders equity side. The overall value doesn't change, but the number of shares reflected does change. The second effect is actually on the market price of the share that is traded. Now if there were 100 shares earlier and each were trading at $50, assuming this was the number, the total market value or the market capitalization would be 5,000 here. Now with this transaction, which is basically 1:1 kind of transaction, the only change is that instead of 100 there are now 200 shares. So instead of this 100 there would be now 200 shares, and there would be a new price associated with it, because when we talk about stock dividends this market value doesn't change. So market value will essentially remain the same as 5,000, and only thing that would change would be the price. So this would imprise of 5,000 divided by 200, so this will be equal to $25. So another impact, one on the shareholders equity, and second the price of the share reduces in the proportion of the stock dividend. So here it was 1:1, so the price actually halves. Now that we have seen that only the shareholders equity section gets affected and the market price of the stock gets reduced with the effect of stock dividends, here you can divide this into two parts as per the accounting norms. One, there could be a small amount of dividend that is announced, so around 20 to 25% can be taken as a small number, or maybe a large number. A large could be around 40% and above. The accounting entries for both these parts are kind of different. So if you look at small dividend, there are three sections that gets affected: retained earnings, capital stock, and the additional paid in capital. However, when it is about the large dividends that are announced, only the retained and the capital stock gets affected. The additional paid in capital, APIC, does not get affected in this case.